Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. Today, I am thrilled to be joined by my colleague, Alexa Kane, who is a team member here at Pearl Planning. And we do so much financial planning work together that it's just like we're sitting across from each other talking about a client case today, Alexa. Welcome to the podcast.
Thank you for having me again. And one of my favorite topics, I know we've hinted at an episode in the past.
Right. So it's been quite a while since we had a long-term care episode. For those of you who don't know, long-term care is kind of the term that gets used when you think about care for aging people, nursing home care, assisted living, in-home care that helps you with the activities of daily living. And we titled this episode saying that long-term care is important to plan for and not just kind of hope for the best. But one of the things that I've noticed is the right time for you to get long-term care coverage, if that's the right fit for you. And we're going to talk about that today because it's not perfect for everyone, is mismatched from the time when you really care about it. I know that thinking about how you're going to take care of yourself in old age is not something that people in their 40s and 50s want to think about necessarily. There's a lot of interest when you're in your 70s and 80s, but that's typically a little bit too late to get insurance coverage. And so we're going to kind of like set the table for why you might want to have the conversation earlier today.
Yeah. And I think it is, more in the 50s or as people are starting to care for their parents to see, oh, maybe this is something that we should look at for ourselves as well. And I know we have a note to talk about the differences and how that long-term care has changed from policies in the past to what's available now. So both of those.
I agree. Long-term care considerations are so personal because some people are just like, I refuse to ever be in a condition where I might need nursing home care or extra care in the home. I know we're touching on kind of a third rail when it comes to perspective and emotions, and also it can often lead to just a lot of feelings of fear and anxiety. So I just want to acknowledge those up front, that this is kind of a touchy subject, touchy area. Even family members, amongst family members, in terms of partners or spouses, may have completely different perspectives, one versus another. But let me just touch on a few statistics that I pulled out as I was researching this episode. This is the Women's Money Wisdom podcast, even though we know we have a ton of male listeners as well. And thank you guys for sticking in. But when it comes to long-term care, the considerations statistically are much more impacted when it comes to women. Women outlive men by about 5 years on average, which often means that they survive their spouses. And certainly there's a ton of considerations for those who are not in a relationship as well. 70% of nursing home residents are women, and 58% of women will need high intensity long-term care versus 46% of men. So this is really a topic that is deeply impactful for women. And of course, many women have also experienced the challenges of long-term care from the other perspective as caregivers. Primary caregivers are women in 60% of family situations that a caregiver is identified. So that both impacts our perspective and emotions when approaching long-term care, but it also tends to be a major contributing factor when it comes to women who choose to leave the workforce early or have interruptions in their workforce participation, because so often when you need to give care to a loved one, it's a full-time job.
Yeah, they're crazy statistics, but it has, it does ring true in real life and what we see of that the women are in there for longer and need to account for it and plan.
Absolutely. And, in terms of what these numbers are, national averages right now for needing a home health aide is the median number is $77,000 a year. I would say that's not 24 hours care. It's very difficult to find workers in the home health aide space. When it comes to assisted living, the national averages are about 71,000, and for private nursing care, um, close to 130,000 a year. These numbers are getting bigger faster than inflation. In fact, national inflation averages are running at about 10%. Just stunningly big numbers. I will mention, though, that oftentimes people who have long-term care needs are not going on a trip. They're not, a lot of their food, for example, is part of the long-term care cost. And oftentimes, because you relocate to a facility that private home, the primary residence is not no longer needed, unfortunately. So there often are assets that are in the equity of a home, and many expenses kind of fall off as your needs are primarily that of housing and healthcare. Well, that is a very eye-opening way to start the episode, I would say. But let's talk about solutions. So, first of all, Alexa, I think for you and I, our approach is not a decision going into conversation that you will buy long-term care insurance. There's a large cohort of the population that frankly can't afford long-term care insurance. If your cash flow is relatively modest, long-term care insurance can be just too expensive, frankly. Um, there's also a portion of the population we work with who can adequately self-insure. And so my perspective, and you can tell me what you think, Alexa, is that we need to have a conversation about the risks and considerations. And as we mentioned earlier, your emotions and psychology when it comes to how you look at this are certainly something that we're factoring in. Um, and it's not a foregone conclusion that everyone needs long-term care insurance or can either afford it, or there are some pretty rigorous underwriting standards. So not everybody can qualify for long-term care insurance.
Yeah, absolutely. There's all different boats, but it is worth a conversation and worth looking into it and sitting in that uncomfortable space for a little bit to, make sure you and your family are on the same page as to what is the best route for your situation.
And when we look at long-term care insurance or some of the other options to fund um, your needs and your care, one of the things I would mention is it is often too late to wait into your 70s and 80s when you're like, oh, it's pretty clear I'm pretty healthy. I don't know how long I'm going to live, but sure would be nice to have an extra bucket. Um, One of the challenges is in with few exceptions, you're always going to be a little bit healthier with fewer kind of chronic or pre-existing conditions when you're younger. And so long-term care insurance really does, kind of look at your rap sheet when it comes to your overall health. And that's why, for those listeners who are Gen X and older millennial, when you're between the ages of 40 and mid 60s, I think that's kind of the ideal time. And actually, when we have the possibilities, tipping a little younger can make the insurance more affordable than when you kind of walk up to purchase it late 60s and early 70s. Um, we'll get into the underwriting considerations in a minute. But there's different versions of long-term care insurance. So I'm going to put you on the spot, Alexa, but just use the example first of, kind of the old school long-term care insurance that was sold mainly, I think, to our grandparents' generation and our parents if they were buying it, 30 or 40 years ago. So this is the older baby boomer silent generation version of insurance.
Yeah, and one that, people may have seen when helping relatives out, but it was, the long-term care was set up of you are paying premiums ongoing forever. So, you know, grandma's writing a check every single month and, you know, 10 years down the road, they say, oh, you were paying 100 a month. Now it's 400. And in order to keep getting the eventual or offered benefits, you have to pay those premiums. So it is, I know I experienced it years ago when we were seeing those policies of, people had to make those choices of, hey, do I continue paying these premiums when it's not certain that I will need it? And they were, helpful if you needed care, but they could just kind of snowball and become an issue where, the landscape has changed now. But now they, have switched to a hybrid model where it's life insurance with this long-term care. It's called a rider, but you're getting the benefits there. And so when we're looking at these policies, there's options to do, a one-time lump sum, or you can do pay over 5 or 10 years, but you're knowing what you will be putting in at the beginning versus paying as you go ongoing. So it's a lot, I think, a nicer setup, and it does, give people, hey, we know what the outlay is on these products, and you can really look at, oh, if I had a large cash infusion, should I just do a one-time payment, or I'll use an example where we had clients kind of set up for, the long-term retirement picture. And, this isn't a situation that we want to make sure care is covered. So we said, hey, we've been doing Roth contributions all these years. What if we take, instead of doing the Roth contributions, that amount and redeploy it to long-term care for the last 7 years that you're going to be working? And the retirement picture looks great, but the unknown and the question mark is long-term care. So able to find a solution that they're not going to be paying monthly, forever, but they're getting care that will help in the situation of needing long-term care.
Absolutely. So there used to be a type of insurance, as you were describing, Alexa, that you purchased it and there actually was a way to kind of pay it up, but that was not what most people focused on because it seemed very expensive. And so you had a contract where you would pay that insurance premium in order to remain eligible until you pass away or until you need to have a claim. And if you quit paying it accidentally, which let's think about it, like the people that may need long-term care insurance may have difficulty remembering to make payments. But if you accidentally lapsed and it wasn't caught, it was kind of use it or lose it. So you lost that insurance coverage. And that insurance both became cost prohibitive for the people who subscribed to it because of statewide increases to the insurance premiums. The only way to increase the premium by the insurance company was to give everybody an increase, but those policies have primarily seen many increases over the years, frequent increases. And insurance companies actually had a ton of claims on these policies. So both the people that were paying the premiums got bigger and bigger bills, but also insurance companies were impaired and in some cases going out of business because of the claims with these types of policies. So there are still some traditional long-term care policies available, but they have a massive cost that is not considered tenable in many cases. So that's not what we primarily discuss nowadays. Now, if you know somebody who has one of these policies, first of all, if they would qualify for long-term care needs because they can't meet their activities of daily living, like they can't dress themselves, feed themselves, move around on their own, um, uh, toileting issues, then or memory care needs. And if they have dementia or Alzheimer's, then you should use those policies. Don't wait and see if they run out of money. Like turn in that claim right away. Get on the waiting period. You don't have to pay your premiums then anymore. And this is an important way to kind of preserve your estate and make it work longer. So those are the policies we primarily see that were sold in the past. And then nowadays, it's actually either a hybrid annuity, hybrid life insurance, or in some cases, catastrophic life insurance that also has, or life insurance that has a rider that allows for long term care that is not a hybrid policy that people are tending to go toward. We do a lot of life insurance based, not a lot, but primarily our clients that purchase long-term care are doing hybrid long-term care that is life insurance first. And in these policies, there's several components. So could you kind of go through a few of the components, Alexa, and considerations? So you were describing kind of the premium payments. These are kind of custom and bespoke designed. You're not just like buying one, kind of premium off the shelf. Your age matters, correct?
Correct. Your age, and it is kind of, you can either purchase the long-term care insurance based on, how much you're willing to pay, or by saying what benefit you're looking for in the future. So with these policies, they have the life insurance piece, and then the long-term care component is as a rider to the policy. So the policies we typically look at are, you are paying the premiums and you are doing it in exchange for the rider is what gives it the value, and it's providing a leverage on the policy. So they,
And I
um,
would never recommend these types of policies as being the best way to get access to life insurance, for example. These are a relatively low face value, which is what the money your beneficiaries receive when you pass away. This is really built to give you long-term care buckets of money.
correct. And it is, so you pay your premiums and it's giving you access to a pool of money if, like you said, the two activities of daily living or the cognitive impairment come into play. And the the bucket of money is much larger than the premium outlay. So they, put a limit on how much you can take from there each month of that pool. But it
If you
is,
have a long-term care need. So you would need to qualify with those activities of daily living I was describing or the cognitive impairment in order to start using this monthly stipend for long-term care.
yep. And it depends on when when you purchase it, but the amount is growing and it is providing a leverage on, hey, if we put in $100,000 at age 55, that bucket is 800,000 when we're 85. These are just made up numbers, but it's pretty,
There's an inflation component. So the reason that the value gets higher is either in some cases or many cases, there's a compound inflation based on an agreed upon percentage, and the cost of the policy would go up or down as the percentage goes higher or lower for your inflation factor. Um, Other policies might have um, be tied to the returns of an index like the S&P. And some might not have a cost of living adjustment, although oftentimes for these types of policies, it's more attractive to keep track with some inflation, even though we've said that those costs are advancing in higher than inflation. Um,
yeah. They are. The costs are going up, but when we do have these conversations, the long-term care policy is not meant to cover every single expense because we don't know, you know, are you going to need care for a year? Are you going to need it for 15? Is it going to be in a memory care facility or have someone at the house? All of those are, big question marks, but it does provide a large asset pool for that. And like Melissa said, you're not typically taking the vacations, you're not going out to eat. There's costs that go down, and then on this side, the costs do go up. But it, provides the funds, but also, in my experience, probably with you as well, it gives, if there are two spouses, it gives the other spouse the breathing room or the children to say, hey, you know, if there's not the a policy that's job is for long-term care, oftentimes the spouse or the kids are trying to provide the care themselves to preserve the portfolio for others, where if you have a bucket that says this is for long-term care, the second you're hitting those two activities of daily living, it's, hey, we're going to start tapping into this, and we're going to have someone, provide some relief for the spouse of, it's very hard to care for people, and it can cause harm to the spouse or the children to try and take on that role when they're not trained to do it. So this gives that space to say, wait, we have this preserver to help us, you know, not overexert ourselves when we're, you still have all the mental load of the care and all of that, but to not be physically tied to it is a big blessing if it does come into play.
Absolutely. I think, again, we're not saying every family. It's important to know that this isn't a blanket piece of advice. Um, but for more cautious families or individuals where you might not feel comfortable spending your retirement income, this could be an impediment to your level of comfort with retirement withdrawals. This can provide some additional confidence, because that one of the big, kind of things that could go wrong later, and hopefully later in retirement, would be insured for to reduce or mitigate the portfolio. Other instances are people who don't have family that would naturally be inclined to help them out. So, child free individuals, single individuals would maybe more likely to desire to have that insurance coverage. Um, Also, families with an age gap between partners, where or a known physical or health condition for one family member who might not be able to be insured, but also the family understands that there may be higher anticipated costs for that person. This could be a protection for the other family member, um, knowing that more assets may need to go to their spouse because of their age, and making sure that there is protection kind of left over. So some components of that hybrid life insurance long-term care are a relatively low. If you don't use the insurance and pass away, then there's a death benefit, a life insurance benefit for your heirs that is relatively low, often similar or just a little bit more than what the premiums you've put in. There's also, if you just change your mind and didn't want it anymore, maybe I don't know, you won the lottery and you just have more money than you could ever imagine. You can turn in the policy for a little bit less than what your premiums were, and it takes a while to get back up to that amount. That's what there's like a surrender period. But then there's this big bucket that has a multiplier and is growing often based on inflation compounding, that can be available for long term care. Now, why does the insurance company want to provide this bucket? Well, a lot of people who end up using long-term care don't use it forever. So they may have a very serious health condition and they use long-term care for a matter of months or a year, and then the insurance company gets back the difference between what they outlaid and the death benefit amount. And so that's why the insurance company just doesn't let you write a check for the full hundreds of thousands all at once, is that they know that there will be many individuals who aren't in a nursing home for 5 or 6 years or needing that care. So there's a lot of different variables. We always encourage families to like spend some time with these conversations, and we would have, one-on-one conversations depending on the considerations for more than, a 20-minute period to talk about whether it makes sense. Can you talk a little bit about how these policies get underwritten? So all long-term care, like all insurance companies are like, we want to make sure these people are very healthy and independent physically in order to issue the policies.
Yeah, and long-term care is an interesting one, I guess for us familiar with the life insurance world as well. But with typical term life insurance, if you apply for that, um, nearly everyone is approved, but just at different rates. So depending on your health class, they just tell you how much it is going to cost. Where, yeah, with the on the long-term care side, um, after going through the underwriting process, it is a yes or a no on if you can move forward with it based on their actuarial tables. So it is at that point in time, are you approved or not? And then typically, if you're not, there's a 12-month window, and then you can choose to reapply depending on the situation. But when we go through that process, it's a little different depending on which carrier you choose, but there is typically the application process is done, which is getting all of your demographic information. And then once submitted, they will do a more in-depth interview, either on the phone or online, depending on your age at the time you apply. Because if you do things younger, there's often an option to do the interview online, of answering a lot of medical questions. They're really just diving into your history and what the risk is for them. And with life insurance, the risk is that you will pass away, and with long-term care, the risk is that you will not, but you will be in in the care facility. So they are, looking for a couple different things than with life insurance on there. So we do have a pre-screening questionnaire that we can get a pretty good idea of, hey, are we likely to run into any issues when we go forward with this?
Yeah, and there's so many different things that could kind of be a wrinkle. You family history, if you like had genetic testing and knew you had a gene that caused um higher, you know, maybe dementia, that could be a consideration that would make it more difficult. If you had past cancer history, depending on the type of cancer, um, there are underwriting requirements for how long you've been in remission. Even needing an orthopedic surgery could be an impediment, and or having physical therapy. So this is definitely perhaps a type of policy that rewards people that use a doctor less.
I would say don't don't say that you're not eligible without looking, because I know in my time, and I'm sure you've seen a few where you're like, oh, like this one is probably not gonna go through, and they do, because it is, there's different time limits on things, there's different things that are on their list of some medications are like, if you're interested, don't don't say no without looking into it, because it's not a cut and dry, or it could never happen. It's hey, it can be a conversation. We can look into it, and different carriers have different things on there. on their list of, oh, this is a no for company X, but company Y allows it. So if we're able to, have our eyes open and be able to look at what it what is available, we can make a plan. And then, I think we do have other avenues to discuss of, if this doesn't work out, that's okay. There's, Melissa talked about the house. There's, you know, all other avenues to explore if it's not the piece.
Absolutely. I think don't I just go in realistically knowing that some people are approved and some aren't. And it is, if it feels like a fit for other reasons, worth looking into. And we can, using specialists, kind of get a good sense based on your background and history as to whether it's a strong possibility of, kind of passing. Um, I think that there's another consideration, which is long-term care insurance typically compensates those that sell it with a commission. So, for example, I think if you're listening, it seems like, oh, maybe they do long-term care insurance, and that's true. This is not our primary focus when it comes to business. In fact, it represents less than 1% of our revenue in 2025 when we're recording this episode, even though it's releasing in 26. But we would have straightforward conversations with the people that we do long-term care insurance for about how we're being compensated on it. Because I have a little bit of a fear, because it is a relatively high commission and a significant amount of money. I often am concerned about, kind of sending people to the wolves, to people that are selling long-term care insurance all day, that they might get oversold and kind of sold based on fear. So having a conversation with the people talking to you about long-term care, about how are you getting compensated and how much would you be paid, um, I think would be recommended as far as I'm concerned. And, help you to understand the conflicts of interest, with those that you're speaking to. And then, another just thing to keep in mind is that if you do already have cash value life insurance, maybe policies that you're using less, and um, you were sold but don't really fit into your life today or your game plan, those sometimes can be used to fund the premium portion of your long-term care. So something to keep in the back of your mind. Alexa, I know we don't have a ton of time, but I just wanted to spend a few minutes talking about, for those that aren't a fit or are not able to be insured, we talked a little bit about alternatives. So there's self-funding, which just means like planning to spend your own money if you have long-term care. What are some other considerations that you might, have when it comes to paying for the costs of end-of-life care?
Yeah, I think self-funding is a big one. And then, as you talked about, if the care gets to, an assisted living type of facility, there is looking at selling the house and using those proceeds to pay for care, um, accessing the equity in the house if it is a situation where one person's in care and the other is at home, with the home equity line or a reverse mortgage. They get trickier, but they can serve a purpose in the right situation there. So those are typically the alternatives of, you know, depending on the asset levels that can fund it, or do we have property that is a backstop?
And Medicaid can't, when you don't have assets and have spent down assets, Medicaid can often cover care. There's more limited choices on where somebody may receive care, and it does not typically provide for home health care. But that is an option for people who are on the lower end of the asset spectrum when they've spent down assets. Um, and then also there are some state-run long-term care programs, not as much in the state of Michigan, but in some other states. And while that doesn't often cover all of the costs of the care, that sometimes can provide protection so that you don't have to spend down your assets in order to, as much in order to qualify for Medicaid. So I'd love to leave people with a few action items. One of them is if you are the primary caregiver or like slotted up to be the primary caregiver for a an older generation or other members of your family, have an honest discussion about how they have planned to pay for any care if they've thought about that, so that you're not in a moment caught by surprise where they're not able to give you as much information and you're kind of in charge. Um, and so, if they, for example, do have long-term care insurance, make sure your name or someone's name is listed in case they lapse on a premium payment to make sure that it continues to be paid and you have information on those policies. Number two, normalize talking about these aging considerations in your financial planning conversations. So some financial planners bring it up, others don't. This is kind of a blind spot if you're DIYing in some cases, not for everybody, but it could be. So, for example, when we do a financial plan, just baseline, we assume that each family member would have 2 years of long-term care, and we put that cost into our retirement projections and calculators so that we're realistically planning for end-of-life needs. And so just normalize the conversation and start to have some, kind of realistic conversations amongst your family members and amongst the professionals you work with, so that you don't find yourself waiting too long. And then third, if it does make sense that you think, oh, someday I'd like to consider long-term care insurance, don't hesitate to start the conversation. At a younger age than you might think would be natural. So waiting till the kids are out of the house and everything's kind of wrapped up and you're retired may not be the most cost effective or the most insurable route. And so hopefully this is like a constructive way for you to start thinking about those discussions. If you feel like it will be on your to-do list someday to act, it might be worth a conversation today. Any last minute recommendations that you have, Alexa?
No, I think that those are great ones. And it is like we have to get comfortable with the uncomfortable topics, and that makes it better for everyone that you care about to be thoughtful when you're able to. And
Well, where can people find you, Alexa? And if they find you, they'll find me as well. But
well, our website is great. So proplanning.com. And then I think we're getting more active on Instagram, but LinkedIn's great. All the social medias, Facebook, we're out there. And the podcast is also great. I think we did one like 4 months ago together, which was a little bit book related, a little.
yeah. Well, we love having you back on the podcast, Alexa. And for those of you that don't hear from her every week, she's doing great work here at Pro Planning, week in and week out. So, way to kick off the 2026 with a weighty but so important topic. Thanks for joining us.
Thanks for having me.
Thank you for listening to the Women's Money Wisdom podcast. If you found value in this episode, the best way that you can support the podcast is to forward an episode to a friend or leave a review. Go to proplan.com and the podcast link to get all the resources and links mentioned. This presentation by Pro Planning is intended for general information purposes only. No portion of this presentation serves as a receipt of or a substitute for personal investment advice from Pro Planning or any other investment professional of your choosing. Copies of Pro Planning's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or on our website platform at proplan.com. The information that we share is meant to educate and inspire, not serve as personalized financial advice. Everyone's situation is unique, so be sure to consult with your own financial professional for guidance that fits your life. And just so you know, the opinions shared in this podcast are Melissa's own and those of her guests. They don't necessarily represent any organizations with which Melissa is affiliated. For more important disclosures, please go to our webpage at proplan.com.